Morgan Stanley sees a serious growth slowdown due to the tariffs. It expects US growth to slow from 2.5% in 2024 to 1% in 2025. Global growth is expected to slow from 3.3% last year to 2.9% in 2025. Asia's from 4.6 to 4.3 as the table is indicating. And India's growth is expected to slow from 6.7%. This is calendar, okay? Calendar 2024 to 6.2% in calendar 2025. Now, what does this mean to inflation, interest rates, yields, dollar, rupee? I have with me Chetan Ahya, the chief Asia economist for Morgan Stanley, joining us from the sidelines of their conference. Good morning, Chetan. Thank you very much indeed for your time. Well, let me start with my India bias. The latest GDP numbers were stronger than expected. It beat our poll even on a full year basis. So our poll said 6.3. The numbers come at 6.5. Does that enthuse you a bit that India may do better than the 6.2 you have forecast for the current year?
Yeah, I think it's possible. But look, I know the GDP numbers were a bit stronger. But if you look at it adjusted for the indirect tax effect, then the number was 6.8. So I think the underlying number was less robust than the headline number. But nevertheless, I think it's definitely indicating that India is at least having a starting point before the tariff effect takes in. Which is, it's much stronger than, in fact, everybody in the rest of the world as well.
Okay. So it's possible that our FY, I mean, yours is a calendar forecast. Will the FY forecast have an upward bias? Is there a chance it'll be upped?
Well, I think at this point of time, we are saying that the risks are like balanced, because, from a global perspective, you have this tariff uncertainty. Our global team thinks that there are downside risks to that global view, which lends some downside risk to India numbers as well. But at the same time, the India-specific factors, i.e. that policy support has been great. As you saw, March number for both central and state government for capex were extremely strong. So the starting point for India is from the policy support such that you could have that downside risk being balanced by the domestic factors. Oh. So at this point of time, Latha, we are still maintaining our base case growth numbers for India.
Okay. Let me come to disinflation. You make a strong case that disinflation is likely to continue in Asia. Will that apply to India as well? Very strong disinflation?
Yeah, exactly. I think all the points that we're thinking about for the region is applicable to India. The starting point of inflation is low, i.e. that it's actually below target. You have lower oil prices. You have this tariff effect, which is deflationary for emerging markets and Asia and India. And at the same time, you have the strength in the local currencies in the region, including INR. All of these factors mean that inflation is likely to remain below 4%, and that actually provides great comfort to the RBI to go ahead and take up rate cuts.
Okay, and that's what I was coming to. If I mean, your inflation forecast will run alongside as you speak. You have a 3.8% inflation for the full year, and yet you say that the RBI will give only 2 more cuts. Why can't they go more aggressive if your expectation is that by Q4 we go as low as 3.6? Isn't there space for more cuts?
Well, I think the framework that we are approaching this is that, you will have real interest rates in the ballpark of about 1.5%. Okay. And considering that, we are not expecting a big dent to India's growth story, since growth conditions will still be reasonable, we think RBI should take up 2 more rate cuts. Now, if we are seeing further downside to our growth numbers, then we are saying there's a possibility the RBI does 75 basis points instead of 50 basis points more. But I think anything more than that would really be dictated by the growth outcomes. They have to be much worse than what we are building in right now.
Okay, much worse than the 6.2% that you all are factoring in right now.
That's right.
Okay. Well, let me come to the dollar. We have been surprised by the kind of weakness that we have seen. Will this pass? Do we see it go back above 100, the DXY that is? Or is dollar likely to remain, a weaker currency?
Well, our house view is that the dollar will remain weak. We are expecting another 9% odd depreciation in the DXY. We think euro and yen are going to be appreciating strongly against the dollar, but also emerging markets will see some upside. Not as strong as euro and yen, but they will also see some upside. So yeah, that's the dollar view. The driver for that thinking is essentially twofold. That tariff-related uncertainty plus the additional policy actions that the U.S. has taken will slow U.S.'s growth more. Just if you take the example of, growth differentials between U.S. and Asia, U.S. will slow from 2.5% in fourth quarter last year on a year-on-year basis to 1.1% by fourth quarter of this year, whereas Asia in all will slow by 90 basis points. So U.S. will slow by 150 basis points, Asia will slow by 90 basis points, and India will slow even less by like 50 basis points. So we are going to have that dynamic where growth differentials are moving back in favor of Asia and also rest of the world. And then the other driver is that the U.S. is running relatively high fiscal deficit, which is in turn drawing current account deficit of 4% of GDP. These are the main fundamental factors. And on top of it, there are some concerns related to the provision that they have made in the bill that has been passed in the House. It's called Section 899. That is raising some concern in investors' mind about potential taxing of income from investments in the U.S. So I think a whole lot of factors are at play, but net, we are expecting this weaker dollar trend to continue.
Yeah, actually, the Section 899 has not been discussed enough, probably because it impacts OECD countries more. But be that as it may, what is your US team telling you about US yields and the Fed action? Can we continue to have such a interest rate differential narrowing between India and the US?
So we are expecting the U.S. 10-year bond yield to go down to 4% by end of this year. And the assumption that we are making is that as U.S. growth slows and job growth slows, market will begin to price those rate cuts that we have, a lot more of those in 2026. But market gets ahead of that and starts to price in from the back half of this year. And that's how we are seeing 10-year bond yield going down to 4%. So, yes, there are concerns on fiscal deficit, but to the extent to which the private demand will slow, that will result into job numbers slowing and then expectations that the Fed will cut rates.
Chetan, there is one factor that is not getting discussed enough in terms of growth, and that is the way in which China is sitting over the rare earth magnets. It was a month ago that Rajiv Bajaj told us that I fear we don't have enough rare earth magnets and the Chinese are stopping them. Yesterday, we had Sudarshan Venu of TVS telling us, and today we understand SIAM, the Society of Indian Automobile Makers, has written to the government saying that production can come to a standstill. Will this be an unexpected quarter, area which can impact our growth, the Chinese behavior?
Well, I think that risk is there, but from what I understand is that there is a process that China government has put out. And unfortunately, if the process is such that every country and every country's private institutions have to give some kind of an undertaking to indicate that this is not going to be used for defense, that process is a very time-consuming process if you want to deal with the whole world in an individual manner. So I think that time limit that is involved in processing those documents and requests is what is, I think, causing that delay.
Let me come back to India and Asia. How do you expect currencies to behave? You said that your team is expecting dollar depreciation to be a theme, continued theme. Do you expect rupee strength? How will the dollar rupee behave?
Yeah, we are expecting strength in rupee as well. In fact, we are expecting a modest 2 to 3% appreciation across the region. But, one of the main anchors for region will be RMB, right? And for RMB, to the extent to which they have deflation problem in China, we think that there will be less appetite on the part of the Chinese policymakers to resort to some meaningful appreciation, like what you're seeing in euro and yen. And at the same time, tariffs are unfortunately going to hit China the most. So both those factors, we think, will mean that RMB will sort of constrain the overall, region's currency appreciation. It won't be as strong as what you're seeing in euro and yen.
Okay, so you're likely to see a very rangy movement. Just a final point, is this pain about to last for a year more? Because then the US midterm elections come in, and then low growth and high inflation could become election issues. So do you think there's greater relief in FY26 for India and for Asia?
Yeah, I think we should see an improvement in growth trajectory for back half of this financial year itself. Because, we are seeing that tariff effects will be most acutely affected until fourth quarter of this year. And then from first half of calendar year next year, you should see improvement in growth across the world, but particularly out in India as well.